another crazy week in the markets last week. Everybody got excited about the Federal Reserve's dot plot chart, and maybe we've seen the end of inflation. Indices jumped, stocks jumped, yields dropped, and the phrase "we are so back" rang out on Reddit boards and financial social media across the internet. But is that right? And what do we do about it? My name is Daniel Schwarzman. This is the long and the short of the markets for December 17th, 2023, where we'll try to put all of that into context. Subscribe to get more of these videos every Sunday or Monday. My usual stance as an investor is one of a skeptical optimist. I believe the system will work. I believe the economy will grow, but I'm also worried that things might get worse or that I might be wrong. When stock markets go up and fast, I tend to duck, to crouch, to worry that things might fall. I also, at the same time, try not to think too much about the stock market. I'm one of those people who prefers to not worry too much about the stock market as a whole or about the economy, but instead to focus on individual companies. My goal is to find disconnects between the price a stock is selling for and what I think it is worth. That's where I try to spend all of my energy. In this video, though, I want to flip it around and actually talk about the market level. And I want to do it from a different angle. While value investing is founded on the principle that the market, the participants out there around the world, are wrong about a given company, in this video, I want to pose the question, what if the market is right to be excited about stocks? And what do we do with that information? Here's what sets me on edge. The S&P 500 is up about 23% this year, and that's before you count dividends. The NASDAQ is up 41.5%. The Russell 2000, which represents smaller companies, the types I tend to invest in, is up more than 21% in just the last 7 weeks. When things go up that fast, it puts me on edge. I get worried about what's happening. And especially when we weren't necessarily starting from a cheap point at the end of last year, even though it was a bear market. At the same time, those are all measures of price. What about the value? According to the Wall Street Journal, the S&P 500 is trading at about 21.6 times earnings from the last 12 months and 21.25 earnings for the next 12 months. Macro Trends, another website, has the S&P 500 at 24.3 times, which is higher. But when you look at the last 10 years, it's on the higher end, but it's not so crazy. It's in line with where we were in 2016 and 2017, for example, both of which were good years. I don't know exactly the quality of that data, but that's not such a crazy multiple. It's not so insane. It doesn't feel like we're in a wild period from just a price perspective. Then there's the economic picture. I'm not a macroeconomist. I only studied that in college. But let me give you some data that would explain part of what's happening with the stock market. So ultimately, the stock market is an indicator for the future of growth in the economy, at least in corporate profits. Let's start with GDP, gross domestic product. That is up 5.2% in Q3 2023 and has been consistently up for the last 6 or 7 quarters. And that's on a real basis, meaning adjusted for inflation. It's not just that prices have gone up. 5.2% is a great number. 3% is usually considered more or less a decent average number for us, the biggest economy in the world, like the US, and one that is relatively mature. The biggest threat to the economy, at least to how people feel about the economy and to the stock market to some degree, what probably in part triggered the sell-offs of 2022, though there was also COVID hangovers and expensive valuations to factor into the picture, was inflation. And inflation is starting to come down. Not meaning that prices are dropping yet, though I'll come to that, but that the rate of price growth has been declining in 2023, especially when you start drilling beneath the surface a little bit. That rate is lower when you look at the last 6 months versus the last 12 months. That's important. Shelter is a major factor, and it's considered a lagging indicator because of the way the different indices measure shelter, where we live, how much we have to pay for rent, and so on, that's dropping even more. Or, excuse me, it's not dropping even more, but it should be. It's on a real day-to-day basis, it's not rising the same way that it looks like in the indices. So, as that will play out, that should weigh on inflation. And on a core basis, inflation is looking better and better. If we get to that point, that's really important because the Federal Reserve, our next indicator, the one that did the dot plot, this is the central bank of the United States, their raising of rates likely plays a part in inflation dropping. As money gets more expensive, we spend less of it, which lowers the demand that drives inflation in part. With interest rates at 5.25, 5.5% right now, but the Fed keeping them even for the third straight month or third straight meeting, and saying that the Fed is planning to cut rates 3 times next year, that's a sign that money is not going to get more expensive, bluntly. And those cuts are meant to track with the further drops in inflation. That's exciting. That suggests that we've got into the other side of the inflation problem and that we're going to be able to expect more stability in prices. We're not going to have that feeling that every time we go to the grocery store, things are getting more expensive, which is a real drag on the economy and a mental drag on the economy. There are other positive signs for inflation, like commodity prices shedding their COVID gains and going back to more or less where they were before the pandemic, and even murmurings from retailers like Costco saying that actually we're starting to see deflation, which would mean decrease in prices. That's its own problem, but it would be a big deal compared to where we're coming from. And the biggest thing about all of this is that we haven't seen major losses in jobs. Quite the contrary. The economy in the US is continuing to add jobs and has every month since January 2021, an average of 417,000 jobs added each month, according to the non-farm payrolls report. If you go to the last 6 months, that number gets smaller. It's only an average of 186,000 jobs a month. But that's still a decent number, and it suggests the economy is able to expand even as we bend the curve of inflation, which defies modern economics and the theory that to beat inflation, you have to cause job losses and a recession. The fact that we've been able to bend all of this is meaningful, which brings us to companies again and earnings, corporate profits, which is what matters for stocks. If we don't have to start modeling in a recession, if we're able to get over the rise in interest rates and the rise in inflation without causing people to lose their jobs, if they have money still to spend, to save, to invest, and if companies can continue to invest, grow, and expect more earnings over time, that would lead to higher stock prices. That would make multiples less aggressive in theory because as companies grow their earnings, they will grow into the multiple. All of that is a pretty bullish outlook and justifies why those stock returns that I mentioned earlier have played out over the course of the year. Do I believe all this? I don't really know. I don't have a super strong opinion here. I want to be open to the fact that the economy does seem to be doing better than we might have expected otherwise. Remember, there were people predicting a sure recession in 2023. That hasn't played out. Many are saying it'll still come in 2024. We'll see. If we're able to get across this into the so-called soft landing, that would be really encouraging and it would be supportive of stocks. If I'm not mistaken, the last well-known soft landing was in the 90s, in the middle of the 90s, and through the end of the 90s, we saw what happened. The last thing I'll say about this from a macroeconomic perspective is when the pandemic happened, everybody was talking about this concept of the roaring 20s. We're going to see the roaring 20s again the way we did 100 years ago. I don't know. I don't know if we're going to end up seeing that or not, but that was a meme, that was a concept just a couple years ago, and it's possible that we still have growth left in us. Which means for stocks, as we're trying to find companies that have potential opportunities, we shouldn't get anchored to whatever the prices were a week ago or 7 weeks ago or 8 weeks ago or what have you. We should be looking at each stock fresh and saying, how much is it now? How much do I think it's worth? And if there's an adequate margin of safety and if there's room for things to go higher, then it's worth buying, whether it's now or whether it's in a downtime like it was in the end of October. That's our job as investors. Which brings me to the main point of this video, what do we do and how do we manage these different headwinds, tailwinds, excitement, energy? How do we deal with what's happening in the market right now? I'm going to go back to the masters, to Warren Buffett in this case. Two of my favorite Warren Buffett sayings are connected. One of them says more or less, when you buy a stock, imagine that you buy the stock and then the stock market shuts down for 10 years, meaning that you can't sell the stock once you buy it. That's the time horizon. You should be the time frame, the outlook, the way of approaching a stock when you buy it. The contrast to that, or the other side of that coin, is wait for a fat pitch when you're trying to buy a stock. You don't have to swing at every stock in the market. You don't have to try to buy everything. Wait for one that really makes sense to you, where you think a big opportunity is, and that's when you swing. I don't apply these concepts 100% to my day-to-day. I have to be honest. First of all, I am not patient enough to only wait for fat pitches. I own something like 25 stocks. They're not all fat pitches. I think all of them are worth more than what I bought them for, but there's no promise there, and there's no way of saying that I'm going to be really super duper excited about every one of those stocks. And of course, I'm susceptible to what's happening in the stock market. I can't think about 10 years. I feel only confident about looking at the next 2 to 3 years. If I get it right for 2 to 3 years, I reevaluate. That's loosely how I approach things. This idea of holding for 10 years, it's a nice ideal, but I can't get there in my actual practice. But I try to keep the concepts in mind. I especially try to when news happens, whether it's something like last week where everybody gets really excited, or especially when there's bad news. Whenever a bad thing happens to one of my stocks, I try to remember, what if I was on vacation right now? What if I was in some remote area? I was hiking through mountains in Central Asia and I didn't have a chance to check the market. What would I do? Nothing. I wouldn't overreact in the second. I would get home, I would see what happened, I would catch up, and then I would make a calculated, rational decision. I would try to take the emotion out of it. That's important here. Which is not to say that I did nothing last week. I can't help it. I'm on my computer all day. I am not in the mountains in Central Asia, unfortunately. And I am seeing what's happening, and you get that FOMO. You get that feeling of stuff is going on. To say generally what I did, I made a few sales of stocks that I was planning to sell when they reached a certain point. I had limit orders that filled because the stocks reached a full value or even overvaluation in a couple of my biggest positions. I sold a bit of another stock which had dropped a lot in October, had recovered. I had changed my analysis of the company and felt less excited about it. And I decided I wanted to reduce how much I owned of it. So that was more or less a planned sale that came to fruition last week. And then more of the nervous energy came out in me researching a new stock that I came across. And I said, all right, I want to get something that seems cheap. Let me look at this stock. It didn't rise a lot with the news last week. So I said, okay, I'm going to buy this stock. It was a small position. It is a small position so far. In the end, I sold about 1.5% of my portfolio and bought a little less than 1% back. That was my activity last week. But it was there. There was that FOMO. There was that desire to figure out what's going on and to feel like, on the one hand, I'm not missing out because stocks are going to go crazy and they're going to keep going up and I'll never get the money that I want to invest into them. And on the other hand, stocks are crazy. If I don't sell now, I'm going to miss out on my chance. I'm going to feel like an idiot if I don't sell at this price. Those are the two sides, both devils, I would argue, that are arguing in my ear. And my job is to let out a little of that energy. I like to say that it's worth having up to 5% of your portfolio that is reserved for that sort of energy, that sort of play or speculation, or just go and do something so that you're acting, so that a 95% of your portfolio is left for the sitting quietly in a room doing nothing, which is a Pascal saying, I believe, and is also an important saying to keep in mind. Sometimes you just have to sit, wait, continue to analyze, but do nothing. That's where your money is going to be made in the stock market. The economy and the market is important, at least in a background sort of way. If I'm looking for a difference between what I think something is worth and what it's selling for, between its value and its price, I should act on that even if the market is going crazy like last week, or even if it's in a bear market environment like the end of October, for small caps at least. I should be keeping mind, though, of what's happening in the broader economy and of how that affects my mental state and my emotions and how to manage for that. And if the disconnect that I was looking for disappears and it's a good time to sit and wait or to sell, I should be doing that again, irrespective of what's happening in the economy. Peter Lynch famously said that if you spend 13 minutes on economics in a year, 10 of those minutes are going to be wasted. He went on to clarify that he means predicting what's going to happen in the stock market, whether the market is going to rise or fall in 2024, whether interest rates are going to be cut 3 times, 2 times, 0 times, or 5 times. And all of those things, those are beyond our control. You should, of course, know what's happening with your stocks and in the economy in a way that might affect your stocks. His example was if you're invested in auto companies, you need to know where car prices, used car prices are going. That's important. As we try to balance these things, the most important thing is to always come back to the companies themselves. Does a company's life change because it's now more likely that interest rates are going to be cut next year? How much does it change? How much does that affect our perception of the company's value? How much does that affect the market's perception of the company's value, which is the price? Those are the things that we need to zero in on. That emotion is going to be there, especially when things do move fast. That's inevitable, whether it's March 2020 or last week, whether it's down or it's up. There's always going to be that emotion, and we have to be aware of it, accept it, but then also focus on what matters. We're looking for companies, we're looking for disconnects, and that's where we're going to act, whether it's as fat a pitch we want, or we just have what we need for our margin of safety, and so on. My name is Daniel. That is the long and the short of the market for this week. You can check out shortinvestingguide.com for more videos on how to invest in the market. I'm going to start putting out a new course in the start of the new year. You can also check out my new registered investment advisory firm, Middle Coast Investing, at middlecoastinvesting.com to see more of how I invest in the stock market and learn more. Subscribe to this channel to get more of these videos. I try to put them out every Sunday or Monday. We'll see what we do over the holidays. I don't know yet. But thank you so much for watching, and I hope to see you again.